Now is the best time as an investor to invest in startups.
$10,000 to create a fund.
We started as a rolling fund to sort of build that brand awareness, and then from there we took it to a $10 million. We're an early stage venture capital fund which invests in LGBTQ plus founded companies as a way of creating greater access to capital.
Max Pog builds a startup studio.
Hi, my name is Max. I'm a founder and I interview other founders of venture studios, startups, and VCs, investors, angel investors. All are my guests on this podcast. Today, my guest is Ben Stokes, founding partner of a VC fund named Chasing Rainbows, helping LGBTQ plus community of founders to launch and fund their startups. We talked with Ben about his path to create VC fund, his education in this field, how to attract limited partners, how to attract founders of startups, and all this stuff around launching and running a VC fund. Hope you enjoyed this video. Subscribe to the channel. Let's start. Can you please share your story, how you decided to create a VC fund and what was your previous experience?
Yeah, sure, absolutely. So I started my career as a founder myself. So I had a company called Social Table, which was a social dining platform. So the idea behind it was that you could book and pay for a single seat at a group table at a restaurant as a way of meeting people. So think dining with strangers and hopefully leaving with friends at the end. You know, one of the things that we're really proud of is the fact that during our platform, we took away any form of bias by actually removing photographs from our platform completely, and actually had people jump on at the restaurant. They actually got an email before they arrived with everyone's first name and a list of random facts about the group. And so everyone got to sort of go there with their genuine interest to get to know who else was at the table, which I think was a really great way to sort of do that. Obviously, when the pandemic hit, however, we had to pivot. And so we pivoted to taking it all online. And we sent wine, beer, spirits, and tea directly to people's houses. Once then, we had them jump on a Zoom call with a sommelier, where the sommelier walked them through a wine tasting for 30 minutes. And then we broke them out to breakout rooms based on an algorithm that we created to ensure that people were meeting like-minded individuals. I pivoted one more time during the pandemic as well with to sort of like take it from a B2C company to a B2B company. And what we did there is we really focused on how we could sort of help companies keep company culture alive during the pandemic, which was one of the challenges, particularly when new team members were joining companies as well. Yeah, I exited that company in 2021. And I kind of really during that time I was angel investing as well. And I sort of really wanted to sort of have the opportunity to take what I was doing as an angel and sort of create a fund around it. And so in particular, I sort of noticed some trends in the founders I was investing in. And I thought that this could be a really unique space within the VC industry to go after. And so we started as a rolling fund to sort of build that brand awareness. And then from there, we took it to a $10 million traditional fund, which we have now.
What is your education or courses which helped you to go into this VC fund creation?
I started, when I was doing the angel investing, thought about starting this fund and I exited my company, I found this course called Venture Capital University, which I did at UC Berkeley, which is done by the Berkeley School of Law. Adam Sterling runs that program, and he's just been an absolute champion of both my fund and myself, and I'm really, really grateful I got to meet him and the other classmates I met as well. So I did the online class. So you do it remotely, and you jump on every week essentially for like a couple of hours to do the tutorial. To do the study, and then once a week you also have a tutorial where it's a Zoom room and you get to actually meet some of your classmates as well. So I found those classes to be really great opportunity. From there, I also have done a couple of fellowships as well. So I did the Material Change Institute, which is run by a woman named Eve Blossom, which is really focused on how to be a real leader in this space, particularly in venture capital, and really focused on how do you bring, what makes you unique and special into what you do in terms of your profession, and how you really differentiate yourself within that market as well, and really stand up as a leader. I've also been part of Plexo Capital, and Recast Capital as well. And then I've also been part of now the VC Include Fellowship as well.
For how long did you study those courses?
Venture Capital University class is, I think, eight weeks, I think, on memory. And then the Material Change Fellowship is a year. The Plexo and Capital and GP, Plexo GP and Recast Capital classes, they were about 3 months each. And the VC Include class is about 6 months.
And what is the stage of your fund now? So have you already got all commitments for the all 10 millions, or you are in the process of fundraising?
Yeah, so we're still fundraising our fund, and I probably should tell you a little bit about it. We're an early stage venture capital fund which invests in LGBTQ plus founded companies as a way of creating greater access to capital. We really believe that population in particular has been grossly underserved in terms of the amount of capital that has been given to people. As well, on top of that, like so many founders have gone back into their closet based off the fact that they feel like being LGBTQ plus is actually a bad mark against their name. And so we really wanted to focus on the fact that these founders are not only capable, but exceptional. And we really wanted to give the opportunity for those founders to get that access to capital to really show what the community can achieve.
And when you started to raise capital, and do you have already like a deep flow of startups, and did you invest it?
So I personally have invested in about 25 companies myself. On top of that, I invested in 5 companies as the rolling fund model, and then we've invested to date on 3 companies we've warehoused, as well as an additional, I think, 4 or 5 we've got allocation in as well. Both Patrick, my other general partner in the fund, and myself are very fortunate that we are very connected in the ecosystem, particularly in LGBTQ plus entrepreneurship. And so we're part of Startout, as well as Out in Tech and Lesbians in Tech as well.
Do you invest mainly in US founders or in around the world, or what is the geography?
We are geography agnostic, I guess you could say. We can invest anywhere around the globe. However, we are investing currently in this $10 million fund. We're investing up to 80% has to be US based. Outside of that, we can do outside of the US.
Do you create a fund yourself or with other partners?
So I started as a solo GP actually, and then as we sort of really started building more of a presence in the market, it was really clear that I needed to have some more support, and so that's when I asked Patrick Driscoll, who is the other general partner in the fund, to join along. We also have some venture partners as well, Maddie and Katie, and we have a really great advisory team as well.
How you split duties and responsibility, and what is your work for 17 hours a day now?
Yeah, I feel like I work all the time, but I say this, I feel like I'm busy all the time, but I don't feel like I work a day in my life anymore because I love what I do so much. It's such a privileged position to sit in. In terms of the demarcation of what Patrick and I do, so Patrick is focused more on LP education and sort of LP management. So that's his background. And I think that complements very much so my skill set, which is more around from that founder mindset or that founder background. And so I'm really focused on securing really great founders that we can invest in and sort of bringing them through that diligence process. And then Patrick is sort of there ensuring that we have the capital to start deploying into those startups as well.
So let's dive into these 2 parts of important parts of every VC fund. So let's start with creating a deal flow. So how you find those founders? What are sources? Do you have some partners who supply you?
We're really fortunate. I think this is something that I really want to get across to everyone who's listening, is the fact that we are really clearly differentiated in the market. And I think it's really important to have differentiation. And so we're really fortunate because we are, we were one of the very first funds in the world to actually focus purely on the LGBTQ plus community. That LGBTQ plus entrepreneurs have actually found us using Google search. They found us on LinkedIn. They found us in podcasts. They found us in all sorts of places, including partners as well. So Startout is one, as I mentioned, as well as Out in Tech. have been some of our larger supporters there. And so I think it's really important to be able to differentiate, because that's a really good way to find that deal flow. And so that's definitely served us well. And then in terms of some of my personal sort of approaches, so I have certain questions I always like to ask founders when I start a conversation with them. And so the first time I meet a founder, I don't get them to pitch me at all. And instead, I want to just get to know them. And so it's really important as a funder, as you start thinking about how your relationship with founders, you really have to be conscious about how you build a good long-term relationship. And that's really built on trust and getting to know each other and building that rapport. And so for me, the three things that I ask on the very first conversation, which is a 30-minute call, is usually like, talk to me about how you believe you and the rest of your team are uniquely positioned to be able to not only understand, but then solve the problem that you're going after. Then talk to me about the market size, so the TAM. So let's talk about how big that opportunity is. And then the last thing is the traction. So let's talk about the traction you've got to date and really share with me what you've been able to do with either none or very little capital in terms of what you've been able to raise to date, so that I can understand how you would go about being really strategic about like spending capital when you do get capital in the door, to ensure that you get the best return on that. And also talk to me about what you've been able to do with nothing, essentially, because then it really gives me as a funder a really good, clear indication of where you'll be able to get the most out of the capital and use it to the best of your advantage as well. So yeah, the 3 T's: team, TAM, and traction. Yeah.
What are usually like red flags for you? And you can compare like great founder and founder you don't want to invest.
It's a big question, Max. I think there's so many different types of founders, right? And I think that for me, I think being able to have a conversation is so important, and that ability to whiteboard and sort of spitball ideas and things like that. I think the relationship that I have with the founders that we have invested in, I feel like we're really close. And I think the reason why is because there's a lot of trust that's been built, both from their side, trusting me that, and the experience that the rest of the team brings to be able to support them. But also from my side as well, I have to trust that founder is going to really be able to return the capital that we invest for my LPs in my fund as well. And the thing I like to think of is coachability. Coachability is so important with that when I look at founders. And what I mean by that is, like, I'm not saying I know everything, because I definitely don't, and nor does the rest of our team. But we do have some experience in the space. And I think being able to work with the founders to sort of spitball ideas, like I said, and sort of workshop ways to get to market or growth hacking and things like that, I think is really important, because as you start to grow and develop and sort of have that conversation with the investor, and it really allows you to open up a lot more doors. And so, for me, I really want to see our fund be so much more than a check. We want to be able to add so much more value to the founders we work with. And I think the best way we do that is actually by feeling like we're all part of the team working up to the same mission. And because realistically, the founders that we work with, their success is our success. And so I really want to remind everyone that it's really important to add value beyond the check as well, if you can. Yeah.
Let's talk about second part of processes. It is about like how do you attract LPs, what is their profile, and how you persuade them that this is a good opportunity to join your fund.
I think this, right now, it's a really tough time to raise capital for not only founders, but also myself as a general partner of a fund as well. It is really hard. So I just want to point that out for everyone. In terms of how to find a great LP, I think what the approach that Patrick and I have really been focusing on is how do we requirements to become an accredited investor is actually met by quite a lot of people who may not realize that venture capital investment is an option for them. And so what we're doing is a lot of education, and obviously using Patrick's background here, we really are talking a lot to new or first time LPs, talking to them who have been angel investors, who understand a little bit about investing, and sort of bringing them into that investment opportunity as thinking about themselves as a limited partner in a fund. And so that's been something that I think where we've really been able to shine, because we're realistically, as an emerging fund manager, there's limited capital that we can get essentially from LPs, because there's so many other emerging managers trying to access the same capital. And so we've been really conscious about how do we create new pieces of the pie that we can go after that not many others are really accessing right now. And so I think it's really about finding LPs that really want to back your mission or understand what it is that you're wanting to invest in and where you can sort of get those wins, and actually talk to them about how you can build that into a strategy for them. And so I like to think about how do you create an impact-driven investment strategy that creates legacy beyond just blood ties and things like that. And so really thinking about ways that you can speak to the LPs that you are wanting to reach as well.
So usually these are new investors, first-time LPs, because like there is so much competitors which are also fundraising. So you focus on youth, people who even don't consider that there are VC funds and you can become an LP, and probably you teach that there are VC funds, there are the returns, there is LP, and so you teach all of this. And what is the structured program? Like, I don't know, 1 month program or how?
Yeah, so we have actually built out some programs which we're actually working with World Pride for to actually sort of deliver some content around those programs. I think one of the biggest things, and Patrick has actually built out a number of programs as well, which we're using as well. I think, like I said, like it is such a challenging time to raise capital, and we really have to be smart about finding alternative access to limited partners to ensure that you do raise the capital in the fund so that you can deploy that into the startups. And I look at this right now that we're in a time where, you know, any investment you make right now I shouldn't say that. But you know, this now is the best time as an investor to invest in startups, because startups that are able to get through this tough time of, you know, close to being a recession, and those that they come out the other side are the ones that often shine. And you know, you look at the past history in terms of the past GFC and also the recessions previously, you can see that those companies that were founded in that time are now today's unicorns. And so I think that there's a lot of opportunity now for investors to really get those high returns.
How do you attract those people to your program? So is it like advertising somewhere, I don't know, on LinkedIn or Facebook, Instagram?
Yeah, so we definitely do a lot of work on LinkedIn. I think LinkedIn is probably the place where we are finding the most potential LPs. As well as that, I think we're partnering across the ecosystem. So we've been really conscious about where we can sort of partner and ensure that we're giving people access to education. And I think, you know, when I think about the things that we as a fund look for when we're investing in startups, we're also thinking, well, how can we also be a fund that adds that value as well?
Criteria for becoming an accredited investor are like either you have $1 million in assets.
Yes, excluding the home that you live in. Yes.
Yeah, excluding the house. And either you have 200 if you are not married, and 300,000 plus a year income if you're a married person, right?
That's correct. Yeah.
And usually it is recommended that you put not more than 10% of your assets into some risky investments like VC funds and venture capital startups. So usually, what is average check you attract? So, for example, in your fund, what is average check LP commits?
Yeah, so we kind of really wanted to understand how we could help create more wealth generation for LPs as well, and particularly first-time LPs. And so we actually wanted to make that barrier to entry a lot less daunting, I suppose you could say. And so what we were doing with our fund is that we have a minimum check size of $50,000. We're obviously open to a lot more than that if someone wants to invest more. And we have got LPs who have invested more capital than that. But essentially, our idea is to really give LPs an opportunity to sort of get in the door and get their foot in the door and then move from there. So the way that we're calling capital as well is that we're calling capital once a quarter. And so essentially, if you were writing a $50,000 check for our fund, it would be $12,500 per quarter that we would be calling over a 12-month period.
So it is like for 1 year. So
yes,
a limited partner commits for 1 year, and this is divided into 4 payments quarterly.
Exactly, correct. Yes.
Okay.
And then in terms of that, our goal then is to deploy that capital over 18 to 24 months, and then start raising our fund two, which we're looking at doing a much larger fund two.
But this is the usual like 10 years fund, or what is the period of?
Yes, exactly. So essentially the idea behind that is that I as a general partner have 10 years to return that capital to the limited partners. And essentially the way that it works is that, and just, to be very transparent, how the funding structure works here, we take a 2% management fee for a year of the lifetime of the fund. And then on top of that, what we do then is we take 20% of the carry. And so what that means is essentially I have to return the entire amount an LP has invested first, and then I get then the LP gets 80% of any of the profits, and I get 20% of anything else. And so it's as a general partner, the best way for me personally to make capital is not from a management fee, because a management fee doesn't go very far. It's about ensuring that I am picking great companies that we invest in that get those returns for those investors.
And even if the fund is still not closed, I mean that fundraising into the fund. So when you reach 10 million, you close and you already don't take money, right? But
that's correct.
I want just understand for what happens if, for example, we set a huge goal, for example, $50 million or $100 million, and then we are not able to raise it during, like, I don't know, 2, 3, 4 years. What happens?
So you actually only have 12 months to raise that fund after you've done your first. So you can be raising a fund and like getting commitments for as long as you want, essentially. But then once you do your first close, and that's when you start doing your first capital call and can start deploying the fund. You've got 12 months essentially to fulfill the rest of that fund. Now, if you don't reach that, you can get an extension for 6 months from the SEC and to enable you to actually, try and capture that rest of that fund. But essentially, it is you once you've done your first close, you've got 12 months to close the rest.
So it means that, for example, when your first LP already did 4 payments, you have from this time you have 1 year or not? Or it is all during 1 year?
When that person does the first payment, you have 12 months to get all of the payment in. Yes.
But there could be, for example, in 11th month from the first payment, you got new LP who commits for 1 year also. It is okay.
Well, not really, because you've already done your first close. Those LPs are trying before you do your final close. Yes.
And this management fee is calculated from actually money that you got, or from your goal, like 10 million or 50
No,
million?
It's calculated from the money that you've got at the time. Yes. So you get 2% of any of the called capital.
Let's talk about how to create a fund. How much money do you need, and what are fees to create a VC fund in the US? Where are they registered? Also, like startups in Delaware or somewhere else. So how does?
Most funds are actually Delaware. They're LLCs rather than C corps, but yes, they are definitely done in Delaware. You can do them elsewhere as well, but my fund is done in Delaware. So I use Carter to do my fund administration and setup. I think my fee was something around like 10, maybe a little bit more than that. I know that we've got a pretty good deal for us to do it. I hope, please don't quote and don't try and get the same. Talk to someone at Carter. I'm sure they'll do the best deal for you anyway. But in terms of that, we did our fund admin with Carter. I looked at a few other opportunities and other options out there. I looked at AngelList. I looked at a few others, and we actually did our rolling fund on AngelList, and we ended up going with Carter for our traditional fund, just because of their fee structure. I think was much better for us at the time. My advice, to be honest, is if you are going out and wanting to start your own VC fund, have some capital that you can show that you've got a bit of a track record. And that's essentially like start doing some angel investments, start doing some investments into some investment so that you can actually prove out that you can pick good startups, that you do have good deal flow, that you do know people in the industry as well, and start building those relationships as well. If I was thinking about it now, would I tell anyone to go in and be an emerging fund manager in this timing right now? It's hard. It is absolutely hard. But I would also say that, differentiation is really your key. If you can really find your sweet spot about where you fit in the market, I'd say go for gold, because the opportunities that you can unlock are going to be endless.
What you said, that from $10,000 to create a fund, do you have some supporting fees, or I don't know,
yes,
some
so then you have
commission every year?
So then you roughly have fees, capital fees and stuff like that, which I think for us are around $2,000 a quarter. Again, please don't quote me on any of this, but it's so you do have ongoing fees and things like that as well for that management. Yes.
And it is done during the whole lifetime of the fund, right? Or it is first 2 years? Or...
Oh, I think so. I can't remember. And again.
Can you share some other difficulties, or what is the most hard part, except raising capital from LPs?
Yeah, I think the real challenge is actually not realizing that you as a general partner don't get paid until you've started doing your first closes. So the amount of money that you sort of pre-circle in that fund, and as soon as you hit the go button, essentially when you do that first close, I think that time period is something you've got to remember, that you don't necessarily get paid. So it's really important to make sure that you have the funding available so that you're not homeless, that you have food on the table and things like that. So I think that has been one of the big things. I think the other thing as well, I think, is just understanding ecosystem for me has been so important. And I think it's really, really, it's a really big thing to be able to say that you've got great partnerships within the ecosystem. And I think it's really important to be able to foster those partnerships so that you can create a really strong knit group of people around you, so that you are all on the same journey together and working together as a group of funds to be able to sort of ensure that the startups are successful as well. And so I think that there's a lot of opportunity there. I've seen some funds who have been more, I guess, protective of the startups that they invest in, because they want to keep more of that investment for themselves, or more of that startup for themselves. So I take a different approach than that. Personally, I would like to see the founders spend less time fundraising and more time working in their companies. And so for me, it's really important to build great partnerships at every level, including your own, so that you can find great partners to send good startups to, so that you're all winning together. Because the sooner that founder is back working in their business, the more likely they are to continue to move off to that next stage to get that next round of funding, which means your valuation has gone up as well.
And as a VC fund, do you support founders network or connections or some customers? And in what spheres? Do you choose some specific startups in some verticals, or just?
So we're really conscious about how we create value, like I was mentioning before, beyond a check. And so we have this thing called the ecosystem playbook model that we really want to create for our founders. And that essentially is that, say the founder is a pre-seed company and they want to raise a seed round in, say, 12 to 18 months. What we really want to do is actually work with a key advisor to sort of build a strategy with that founder to ensure that they can actually reach those goals. So say, for example, that pre-seed, it's a $10,000 monthly revenue, and they want to get to seed, which is roughly around $100K month in revenue to be successful and to raise that round. So essentially, how do you get from point A to point B? Building a strategy around that with KPIs really built into that means that those founders then, when they go out to that next round of capital, or those next round of funders, who we are more than happy to introduce them to as well, because we do have great networks there, they can raise confidently knowing that they've hit the minimum requirements that those funders require. And I think that for me is really important to ensure that our founders that we work with are set up for success when they go for that next round of funding. In terms of the areas that we invest in, I think we've seen some interesting trends, or some pillars that we're really focused on. And I don't think we went out with that mentality, because, again, when we started the fund, we really wanted to focus on LGBTQ plus founders. But what we're seeing is that there's a bit of a trend, and that is companies that are creating access to healthcare, access to education, financial inclusion and equity, as well as on top of that, environmental and sustainability companies. And so I think those 4 pillars has really given us a really good, strong foundation for the fund, as well as outside of that, when we are investing, that in a company that may not meet all of those, but they still do add really great value to what they're doing in terms of what they're building as well.
Can you compare rolling funds on angel list and traditional fund? So what are advantages, disadvantages of both, and how for whom rolling funds are better and for whom traditional VC funds are better?
And a rolling fund is kind of like a mini fund, I guess is the best way to put it. So essentially what you raise in quarter 1, you then deploy in quarter 2, whilst you're raising quarter 2 to deploy in quarter 3, and it's a constant raise, constant deployment. So you're always raising and always deploying. When you do a traditional fund, it's a little bit different. So you're in a position then where you are, you raise, for a certain period of time, and then you deploy the capital that you've raised after like year 2 or year 3 and onwards. And so essentially it kind of breaks that up. And so that period is a 10-year period. Yes, the rolling fund every quarter, as mentioned, it's a mini fund. And so it is essentially still, those startups are still for 10 years as well. But to be able to return that capital, it just means that you're always raising, always deploying. And I think if you're in a situation where you are, you can either do SPVs where you're doing like a number of different deals, but they're deal specific deals, or you can choose to do a rolling fund. So whatever deals you want to do for that quarter, you can then, that's what you invest in essentially. And so you might have 2 or 3 deals, and depending on how the economics work, I think rolling funds work better than some SPVs. If you're doing a group of deals and there's going to be the same LPs in a lot of those deals, you could probably do a rolling fund, and that might work better for you from a structural standpoint. And then obviously as you become, I guess, bigger and sort of want to start doing raise a much larger fund size, then I think the opportunity to move across to a traditional fund is important there.
Thank you very much, Ben. Can you share what is your findings, advice to future fund managers?
Absolutely.
You already said that it's better to start with angel investing earlier to show some track records that I can choose right startups.
As I said before, I think the big thing is differentiation. So really understand the ecosystem and understand how you can differentiate yourself within that. I think that, as mentioned, there's a lot of emerging managers right now who are underrepresented themselves, who are going after underrepresented founders. And I think you really need to start targeting within that so that you can differentiate yourself against the other people. Because realistically, if I was an LP and I was looking at, a fund manager who had a lot of experience, and then a fund that had, with a brand new manager who didn't have much experience and not much of a track record, I know I would probably put my capital with the one who has more experience, just because I see them. And so, but if you can see as the new fund manager coming into that space that you're going after a unique position, you've got unique deal flow, and you also can show that you've got some track record in terms of what you've invested in before, and you can show some traction and some real wins in that space in particular of what your new fund is going after, then that's always a green space in terms of opportunity, and kind of allows a more, I guess, risk tolerant investor the opportunity to sort of back you in that space as well.
Thanks, Ben. Cool.
Yeah, no worries. Thanks so much for having me. I appreciate it. Bye.
Max Pog builds a startup studio.